Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Great Eagle Holdings Limited annual report. Great Eagle Holdings Limited offers a diverse range of businesses and services across various sectors. At the core of its operations are property-related services, including hotel management, leasing, sales, and maintenance. The company operates hotels under renowned brands such as the Langham, Cordies, and Eaton, providing accommodation, food, and banquet services. In addition to hospitality, Great Eagle Holdings engages in property development, investment, and management. It invests in securities, manages real estate investment trusts, and offers flexible property management services. The company also provides workspace operation services, leasing properties, and selling building materials. Furthermore, the company offers a range of ancillary services, including secretarial, staff, repair, consultancy, and advisory services. Its expertise extends to computer system management, project management, treasury management, and investment fund management. Great Eagle Holdings also provides procurement and financing services, as well as hospitality and hotel management services. In terms of specific businesses, the company operates beauty stores and issues medium-term notes. It manages various funds, including the U.S. Real Estate Fund, and offers property agency services. With a presence in multiple countries across Asia, North America, Europe, and Oceania, Great Eagle Holdings Limited has established itself as a prominent player in the global real estate market. The significant growth of Great Eagle H41HK stock by 47.36% to 50.09% in the past year can be attributed to several key news events. One major factor was the company's robust 2025 annual financial results, which showed a substantial increase in core profit and revenue. The strong financial performance, coupled with improved shareholder returns, positively influenced investor sentiment. Additionally, Great Eagle declared a final ordinary cash dividend of HKD 0.7 per share for the financial year ended December 31, 2025, signaling continued cash returns to shareholders. This move was complemented by a special in-specie dividend of Langham Hospitality units, which unlocked deferred units and potentially enhanced alignment between investors and the performance of the group's hotel assets. The general improvement in the Hong Kong property market has also contributed to positive sentiment around Great Eagle Holdings. These events have played a significant role in the substantial increase in Great Eagle H stock price over the last year, with the company's strong financial performance and strategic dividend distributions being key drivers of its growth. Great Eagle Holdings Limited market capitalization of $13 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Great Eagle Holdings Limited holds a significant advantage in their industry. Great Eagle Holdings Limited trades at a higher price-to-book ratio of 0.24 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 39% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 4.71%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for the company can be attributed to several key factors. Firstly, the core business has seen a significant increase of 114.6%, driven by various initiatives and strategies implemented by the company. Additionally, revenue from property sales has skyrocketed by 650.4%, while distribution income from LHI has increased by 100.8%. The tourism sector has also rebounded, driven by mega events and targeted promotions, leading to improved occupancy rates for hotels. Furthermore, residential property prices have recorded their first annual increase in years, supported by lower interest rates and buoyant stock markets. The hotels division has seen a 4.3% increase in EBITDA to $152.2 million, while LHI hotels have maintained stable performance despite pressure on room rates. Income from distribution, income from LHI and finance, income from the ONMA and TIN project have also contributed significantly to revenue growth. On the other hand, the primary drivers of revenue decline can be attributed to several factors as well. Management fee income from Champion REIT has decreased by 8.4%, while distribution income from Champion REIT has declined by 9.6%. Net rental income has fallen by 3.1%, and other income has plummeted by 51.3%. The office segment has faced a competitive leasing landscape, elevated vacancy levels, and declining occupancy rates at Great Eagle Center. The retail front has also been affected by evolving consumer preferences and structural shifts in spending patterns of mainland visitors. Rental income from investment properties has declined by 9%, while the sale of properties has seen a significant increase of 648.6%. Dividend income has decreased by 13.4%, and hotel operations segment revenue growth has declined by $13.28 million. The net income of the company experienced a mixed trend in the given period. Initially, it increased by 33.7% to $176.7 million, indicating a positive growth. However, later on, it decreased by 1% to $124 million, showing a decline. The reason for this fluctuation is not explicitly stated in the provided information. On the other hand, the profit margins of the company underwent significant changes as well. Although there was an inferred increase in core profit after tax and attributable to equity holders, which suggests an improvement in profit margins, it declined by 5.9% in consolidated segment results. This decline can be attributed to escalating operating costs, particularly labor costs, in London and Europe. Furthermore, the decrease in profit margins is also due to fair value decreases in investment properties, resulting in a loss of $1,001 million. Additionally, the exclusion of fair value adjustments on various items such as investment properties, hotel land and buildings, derivative financial instruments, and other items contributed to the decline in profit margins. The finance costs of the company were reduced by 16.5% to $427.4 million, which might have had a positive impact on the net income and profit margins. However, this reduction was not enough to offset the negative effects of escalating operating costs and fair value decreases. Overall, the changes in net income and profit margins can be attributed to various factors, including operating cost pressures, fair value adjustments, and finance costs. The company's debt level has undergone significant changes over the past year. Initially, the debt-to-asset ratio was not available for June 2025, but increased to 21.1% by December 2025. However, a closer look at the data reveals mixed trends. On one hand, the overall debt level decreased from $25,097 million to $21,413 million. Additionally, gross debts also saw a decrease from $31,978 million to $30,439 million. On the other hand, the debt level increased from $1,729,179 in 2024 to $4,297,879 in 2025. In contrast, interest expenses have shown a significant decline. The company's interest expenses decreased by $457,240, 26%, from $1,770,690 in 2024 to $1,313,450 in 2025. This reduction indicates that the company has managed to reduce its financial burden and optimize its debt management strategy. Overall, while the debt level shows mixed trends, the decrease in interest expenses is a positive sign for the company's financial health. The financial performance of various segments and regions has been mixed in the recent period. On a positive note, Hong Kong performed well, generating HK $3.4 million net rental income from its residential property pool. The hotel operations segment, specifically Champion REIT, also showed strong results with a profit before tax of HK $185,776. Additionally, the property investment segment, led by Langham, reported a profit before tax of HK $416,550. In contrast, several segments and regions underperformed. The office segment was particularly weak, while the retail front at Langham Place Mall also struggled. The Great Eagle Center office portion and San Francisco hotel projects under development were also marked as poor performers due to write-offs of pre-construction costs. Furthermore, other business segments experienced a decline in operating income, with a 0.8% drop to HK $124 million. The property development segment incurred a significant loss before tax of HK $3,131,013, while Champion REIT and Langham REIT also reported losses before tax of HK $1,634,532 and HK $460,588, respectively. Management's outlook on the company's strategy is centered around diversification and growth. The company plans to focus on expanding its tenant mix, particularly in the lifestyle segment at Langham Place Mall, to drive sales growth. This move aims to maintain the property's premier status as a location-sensitive business hub with a stable occupancy rate. In addition to diversifying its tenant mix, management is committed to prudent investment strategies that enhance shareholder returns. This includes investing in quality short-term bonds and equities. Furthermore, sustainability is seen as a key driver of long-term value creation for stakeholders, with the goal of improving the quality of life. Overall, management's strategy emphasizes adaptability, growth, and responsible investment practices, all aimed at creating value for shareholders and stakeholders alike. The company has made several strategic acquisitions to expand its portfolio. Notably, it has acquired over 100 residential units in prime locations through its residential property pool. Additionally, the company has secured office space in Central and Admiralty, as well as a residential site at Choi Hung area through a government tender. Furthermore, it has invested in the Venice Hotel development project on the island of Murano in Venice, and several residential development projects in Kai Tak, Ma Tau Chung, and Choi Hung areas. In terms of divestitures, there is no mention of any assets being sold or disposed of by the company. This suggests that the company is focused on growth through acquisitions rather than reducing its portfolio through divestments. The company has a history of distributing dividends to its shareholders. In recent years, the company has made significant payments towards dividends. Notably, in 2024, HK $373,862 was distributed as dividend. This trend continued into 2025, where two separate dividend payments were made, an interim dividend of HK $306,566 and a special interim dividend in specie of share stapled units worth HK $24,925. These transactions demonstrate the company's commitment to rewarding its shareholders through dividend distributions. There are concerns about inventory buildup or supply chain disruption in the industry. These concerns are evident in various sectors, including distribution, income increase, and write-off of costs for hotel projects, as mentioned on page 3. Additionally, page 9 highlights accumulated sales and loss reported for ONMA and TIN project, further emphasizing the issue of inventory buildup. The office sector is also affected by elevated inventory levels, which weigh heavily on its performance, as noted on page 18. These concerns suggest that the industry is facing challenges related to managing inventory and supply chains effectively. That concludes the financial summary for Great Eagle Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.